Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Welcome back to the Grow Your Wealthy Mindset podcast, where we talk about how to build not just financial wealth, but also a mindset that supports the life you truly want to live. Today's topic is the 50-year mortgage. Trump recently floated this as a way to help with housing affordability. At first glance, it may sound great. Stretch out your mortgage, lower your monthly payment, and make home ownership easier. But is that really how it works? Let's take a closer look. Back in 2014, the Federal Housing Finance Agency, or FHFA, stopped Fannie Mae and Freddie Mac from buying any mortgages with terms longer than 30 years. Now, FHFA Director Bill Pulte says he's working to reverse that decision and bring back longer-term loans, maybe even as long as 50 years. The goal is to make homes more affordable. Housing prices have significantly increased, and for multiple reasons. First, home building slowed way down after the 2008 housing crash, and we've never really fully caught up. Then, during the pandemic, federal spending increased, which led to inflation. Inflation drives up the cost of everything, including real estate and building materials. That means new homes are more expensive to build, and existing homes are harder to afford. When you're making a big purchase, whether it's a house, a car, or anything else, it's important to ask, can I afford the price? Not, can I afford the monthly payment? But most people thinking about buying a home focus on that monthly number. They forget the total cost of ownership, things like maintenance, property taxes, and insurance. Now that interest rates have gone up so much, monthly payments have risen, even if home prices haven't. That's created the current housing gridlock. Many homeowners are sitting on super low mortgage rates. Some are lucky enough to have mortgages under 3%. And those homeowners don't want to sell if it means taking on a new mortgage at 6% interest or higher. With fewer people selling, inventory stays tight, and first-time homebuyers are getting squeezed out. So, would a 50-year mortgage help? Let's use an example with real numbers. Let's say you're buying a $500,000 home with 20% down, which means taking out a $400,000 mortgage. At 6% interest, your principal and interest payment would be $3,375 a month if paid back over 15 years, or around $2,398 a month on a 30-year loan. Stretching out the time period where you pay back the loan does make the monthly payment smaller. However, if you've actually gone shopping for mortgages, you may have noticed that the interest rate for a 15-year fixed-rate mortgage is lower than that for a 30-year fixed-rate mortgage. The interest rate typically decreases when the time period of the fixed rate decreases. A 5/1 mortgage, which has a fixed rate for 5 years, and then after 5 years, the rate adjusts every year, will have an even lower rate than a 15-year fixed mortgage, since the fixed rate is only for the first 5 years of the loan. The difference in interest rate between a 15-year fixed rate loan and a 30-year fixed rate loan can range anywhere between 0.25% and a full percentage. But if you look at recent rates, has been around 0.5%. So if we go the other way and stretch the loan out to 50 years, lenders would almost certainly charge more interest and not less. Why? Think about it from the bank's perspective. They're lending out hundreds of thousands of dollars for half a century. That's a long time to tie up their money. They have no idea what inflation, interest rates, or the economy will look like decades from now. If rates go down, the borrower refinances and the bank loses out. If rates go up, the bank is stuck earning less than the market rate. And over 50 years, that's a much higher risk that something could go wrong. Things like job loss, illness, or divorce, which can lead to a default on the loan. So of course, lenders want a higher interest rate to make up for all that extra risk. Let's say a 50-year mortgage rate is 6.5% instead of 6%. The longer loan would drop the monthly payment from about $2,398 on the 30-year fixed rate loan to $2,255 on a 50-year loan. That's only a decrease of $143 a month. But that covers up the most painful part. Over the life of the loan, you'd pay more than twice as much interest. On a 30-year loan, you pay about $463,000 in interest. On a 50-year loan, it would be almost $1 million of interest. You literally are paying more than double the amount of interest, an extra $500,000 in this case, just to save $143 a month. Not a very good trade-off, in my opinion. And you're barely building any equity. After 10 years, you've only paid off about $15,000 of the principal with a 50-year mortgage. Compare that to over $65,000 you would have paid off with a 30-year mortgage over the first 10 years. So not only do you end up paying a lot more interest, you'll be stuck owing almost the entire balance of the mortgage for years, well over a decade. And we've seen this before. Back in 2003, Fannie Mae started buying 40-year mortgages. The program even expanded in 2005, and by 2008, that's when the housing market crashed. Those borrowers who had the 40-year mortgages were hit hard. They had built almost no equity, and they were in homes that they really couldn't afford. Borrowers who had 40-year mortgages ended up with some of the highest default rates during the Great Recession. The 50-year mortgage may sound like a creative fix for housing affordability, but it's really a trap, one that keeps people paying interest for most of their lives. And it doesn't make homes more affordable. It just makes the debt last longer. Before jumping at the idea of a lower monthly payment, always look at the total cost. Ask yourself, is this a smart financial move or a longer leash on the same debt? The bottom line is this. If you need a 50-year mortgage in order to be able to afford the house that you're looking at, then you really can't afford that house. I hate to break it to you, the 50-year mortgage is not going to help you build any wealth and will just keep you in debt for an extended period of time. If you found this episode helpful, please share it with a friend or colleague who's been talking about buying a home. If you are considering buying a home, make sure to tune in next week, where I discuss how to determine how much house you can comfortably afford. Don't fall in the trap of being house poor. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. Until next week, keep working on that wealthy mindset. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.